Well, if you guys have extra housing, we'll be more than happy to send you some extra communists down there.
Listen, I'm trying to get Luigi to move down here. So that was my sales pitch to him. He's still in New York.
Listen, I always tell Luigi, listen to this. Like when I talk to people about tax planning, especially from New York, I say the best thing you can do is move from New York, right?
Yeah.
That would save a lot of taxes, right?
Let's go!
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the Professor Luigi Rosabianca. What's on tap today, Lou?
Matt, most people don't realize not only are you and I co-hosts of this wonderful podcast, we're also partners. But we have a third partner. You know who that third partner is, Matt? Uncle Sam. No more. Those days are over because we have Julio Gonzalez. Julio Gonzalez is the founder and CEO of Engineered Tax Services. His firm has some wonderful creative solutions for small businesses to offset those tax liabilities. Julio, welcome to the podcast. Thank you for joining us.
Thanks for having me.
Now, Julio, my understanding is the big, beautiful bill is a game changer for small business. Can you kind of offer some insights on how that applies to us average Joes?
There's so much in that big, beautiful bill for so many small business owners, but let's talk about a few that are particularly of interest right now, especially when we have like 70 days left to lower our taxes, right? And preserve our wealth. But R&D tax credits, that was a tax credit really that rewards companies that do innovation, that make their product faster, quicker, and ultimately it was not usable over the past few years because there wasn't immediate expensing related to it. But we restored that. And with this bill, the IRS and Congress came up with a plan to allow business owners to basically go back 3 years and get the tax credits or cash for claiming those R&D tax credits for the previous last 3 years. So home run there, and something every client should look at, right? Every business owner should take a look at that to see if there's money there in their businesses that is untapped and can get back to them.
Let's unpack that for a second, because what you actually said there was we can go back 3 years. So if I did the research and I did the development 3 years ago and I paid taxes on the money, the government's actually going to write me a check and give it back to me?
Yeah, because with the R&D tax credit, really, it's a refund of labor, right? So the companies just spent the labor, they spent money on subcontractors, on supplies, and we take a percentage of that that's dedicated to, improving processes, products, and services. And then we calculate that for the last 3 years and get that refunded to the client. And hopefully we get the government open up and get those refunds flowing pretty quickly. But it's a tremendous home run. I got to tell you that we've had so many small business owners come to us, and now they have this equity in their own company that they didn't even know about. And now we can free that up for them. And obviously that's huge capital for them to continue to grow their businesses. But what a great program that this big, beautiful bill, implemented.
Yeah, what it sounds like to me is like when you go in your closet and you bought a suit 3 years ago, you never put it on. But when you go to put that suit on one more time, you find $100 bill in your pocket. Well, I have a feeling this is a lot of companies on this podcast are going to find a lot more than $100 bill with the R&D tax credits.
I love finding money in my suits and in my pants. So that's a great analogy. I love that analogy.
So can you give us a couple of examples of what R&D is? I kind of think I know the grammar behind it, like research and development, but maybe if you gave us a couple of case studies, a few examples, this way the small business owners at home can see if it applies to their industry and their services.
Yeah, I think I'll give you examples. Like today, we just worked with a small company up in your neck of the woods, Orlando, that makes honey. And but they were, changing the honey to give it different formulas, different tastes, and different flavors. So all that is R&D, right? When you're experimenting with whatever your products or services are, and whether you're trying to create different flavors, different products, or you're trying to make something better. Maybe you're investing in technology to improve your company, your scaling. So It could be any activity that's improving your company and your services and your products. And
Well,
ultimately, I see that as the one of the missed tax credits of all time. And so I'm glad you guys are sharing that with your clients out there.
what about for the people listening saying, hey, I just started my business. I'm not doing that much in revenue yet. Does it still apply? Would this even apply to me?
Yeah, it does. And we have special rules for startups, right? So with that, we can qualify the tax credit and then bank it for them so that when they can use it, right, when the revenues start flowing in and they want to offset some of that taxable income and get those programs, it's there for them. So yeah, we have special startup rules, but ultimately it allows them to take advantage of it.
Yeah, I remember a few years ago, the R&D tax credit was very prevalent, right? And then it got diminished, so to speak, a little bit because of the changes, I guess, in the
Yeah.
administration. But with the big, beautiful bill, the fact that you can actually go back and you don't have to take that deduction the year of is huge.
So big. I mean, this is really great that we not only fixed it in this bill, but we also said, hey, it wasn't so great the last few years. Let's go ahead and allow you to go back and fix it for those years as well. So it's been big for our clients. This is a free source of capital for them, and it's really helping them, retain their company employees and grow their companies. So it's significant.
You know, R&D is one thing, and that's great for a lot of small businesses, but we work with a lot of real estate investors too. And you'll be surprised. I've spoken to people, and I've only learned this product through you, or this rule, or what would you call it? A product? Cost segregation? It's not a product. It's an engineering study report, right? I learned it through you and others, and you'll be surprised how many people in real estate that are active investors, active real estate professionals, don't know about cost segregation. And that's a big thing that you and your firm do as well, right?
Cost segregation is one of the most beautiful benefits in our tax code. It really rewards people for investing in real estate. Like, we want to reward people that take risk in our country, right? That's what the tax code's all about. The tax code says, how can we lower our income tax, right? And this is one of the big rules, because when you invest in real estate, you expense it. So you get a tax benefit, right? But it takes 30 to 40 years to claim that benefit. So you have to spread it out over 30 to 40 years. With cost segregation, what we do is an engineering study that says, well, 40, 50% of this building is not brick and mortar. It's air conditioners, it's lighting systems, it's flooring, it's glass, it's all these components that don't last 30 to 40 years. We've replaced them long before the 30 and 40 years. And so now, say we have a property and 30 to 40% of it is really tangible property. It's not bricks and mortar. Then we can expense that immediately, especially under this new big, beautiful bill, right? Because anything we classify as personal tangible property is immediately expensed with bonus depreciation at 100% full write-off. So how tremendous, right? That was restored, the bonus depreciation, critical for cost segregation studies. So let's do an example. You have a client that buys $1 million property. The report says that the tax benefit from personal property that's not bricks and mortar is 40%. It's non-structural components of a building. Well, then $400,000 is your first year deduction. So I think about it this way. When I was in 2001, when I owed $1 million, I opened this company. I started this company in 2001, owed $1 million. What did I do? With that same $1 million, I bought a $5 million apartment complex. And then I did the cost segregation, generated over a $2 million write-off. So there, I eliminated the $1 million I owed the IRS. I converted tax liability to an appreciating asset, was cash neutral. But then what happened with that property? Dividends every month, right, in terms of rent. 20 years later, that $5 million property was worth $80 million. And this is how people build wealth, right? This is how people build wealth, by taking a tax liability, converting it to an appreciating asset, which the tax code rewards us for doing when we do things like this, when we do R&D, when we do cost segregation, when we invest in the country and we create jobs. We get rewarded. I think so many people don't know that, but we got to take advantage of that. And you're right. How many people own real estate and have never done cost segregation? I would say this, though. The good news is, if you never did cost segregation studies and you own real estate, you can go back 10 years. And all we do is say, you took this much depreciation. under this report, you could have taken this much depreciation, and we can catch that all up in the current year, right? We don't have to amend tax returns. We don't have to do anything special. We just say we missed some depreciation. Here's the catch up in depreciation, and we're all set.
Yeah, it's amazing. I mean, I literally only learned about this probably about 4 years ago. Me and Luigi both had some very big tax bills. We started the company and we're like, what are we going to do? And it literally changed my life. It changed my life so much that we actually started offering this for our clients with partners like you and others out there, right? To actually get real studies done. Because what we noticed was there are some people that say they do a cost segregation, but they don't actually do the engineered studies. So can you explain the difference to the audience? The difference between somebody that's just estimating and ballparking it and an engineered study?
Yeah, listen, great question too. And our company name is Engineer Tax Services. And everyone thinks that I'm trying to engineer taxes, but really we're an engineering firm. We're a licensed engineering firm. We're licensed nationally. We have engineers on staff, and we have engineers that go out and go to the properties and determine what is non-structural and ultimately put that into the engineering report that we send to the IRS to support our studies. And so when you estimate and guess on what that is, that's not really allowed by the IRS, right? The IRS says to do these reports, you have to have an independent inspection report. And who better knows buildings than licensed engineers that have been building buildings and have renovated buildings. So it's really great. We have a great relationship with the IRS as well, but that's the difference, right? You don't want to guess with health. You don't want to guess with wealth and taxes, right? You don't want to get in the hours of the IRS. I see so many clients that had a bad experience and went with kind of some of those estimates. The IRS, when an agent sees that in a report, they just throw it out, right? And then now you're opened up to everything else in your tax return. You don't want that, right? You want a credible engineering report the IRS agent's going to look at and say, yeah, this is good. Let's move on. And so there's a big difference.
Yeah, no, I totally agree. You don't want to get caught out there, especially with the IRS. We know that.
Yeah.
These are some of the strategies that you put together and it's in your book, right? Why don't you tell the audience a little bit about your book? Because I want to dive into a couple other strategies that you guys do that's a little bit more unique.
Okay, yeah. Well, I wrote a book. It's called Why Billionaires Love the Tax Code. And listen, for your audience, all of them can have a free copy. Just text WHY, W-H-Y to 26786, and we'll get them a free copy of that book. But I wrote this book because big Fortune 500 companies, their owners, right, they pay maybe net 9%, 10% tax on their net income, right? Small business owners pay 40 to 50% of their net income in taxes, right? So the government is a much bigger partner to small business owners than it is to the Fortune 500. And why? Because the tax code is complex, right? 2 million pages. And what we try to do in this book is just say, hey, here's 2,000 ways you can quickly lower your taxable income as a small business owner, as an individual. You got 70 days basically to do that for 2025, because we know once 2025 hits, or New Year's Eve, right, there's a lot of things that you lose the ability to do to lower your taxes. And all we want to do is, we understand the government's your partner in business, but they don't have to be 50% owners of your net profit, right? Maybe we get it down to 10 to 20%. This is what you guys do well. This is what you've been sharing with a community out there. And kudos to you for creating that awareness. And that's what the book was. Let's create more awareness. Let's create tax equality between that book through your podcast and getting that information out there.
So Julio,
I was waiting for
Julio, let's just give a couple examples about the cost segregation. Given your example that you mentioned earlier, you bought a piece of property years ago, but as you know, during the course of time, you may make some improvements, you may expansions, renovations. How do cost segs help real estate investors and owners with improvements after they've purchased them?
Yeah, great question. And cost segregation reports should be updated annually for a lot of reasons, right? We made improvements, but we don't want to put those improvements on a 30-year schedule, right? We want to accelerate those improvements and have the same benefits from those investments into our property. Also, in our reports, maybe you have systems or HVAC centers or all kinds of things in a building, lighting that we've removed, right? They exhaust it. They're no longer worth anything, but we still have a remaining balance on the depreciation there. So let's get those expensed, right? Let's update the report so that we're taking advantage of anything we did in the current year, whether it's improvements or exhaustion of assets, things that have no value. And why is that good? Because then when we remove those assets, we get the additional write-off, and we don't have recapture on those assets because they have no value. Those are significant, right? So that's the best way. Just use them every year. You spent the money, right, to do the engineering report to get these benefits, but let's update it. I mean, updating a report every year takes little to no time, and look at the benefits it can provide.
Julio, would this be a good time to explain to the audience the powerful 1-2 punch of a cost seg followed by a 1031 exchange? Because we are reducing our cost basis.
Yeah, I think, cost seg and 1031 are the two most beautiful ways to invest in real estate and take benefit, right? Because now we're going to do a cost seg on $1 million building and accelerate $300,000 to $400,000 in write-offs, right? So we do reduce the basis, right? So now we go to sell that building, and now we have a much lower basis, right? So we're going to have capital gains, we're going to have some recapture, and again, the IRS gives us this beautiful benefit. Instead of having to pay those taxes, we can 1031 into a different property that we can own, or we can 1031 into a DST where someone else manages the property. We used to have 1031 on all kinds of things, arts, jet, everything you can think of, right? But that went away. The only thing they left in the 1031 rules is real estate. But they know how important real estate is to our country and to the activity. So why not give people the benefits? But also, listen, we sell property. Maybe we don't do a 1031. Maybe we go into an opportunity zone. Same kind of benefits in the sense that you get to defer the taxes. And so there's a couple of channels open under the new bill, right? So 1031, they always try to take 1031 away, but they kept it in the bill. They added opportunity zones and extending those so that we have other options as well.
Julio, I love everything you said. I think you left out one key factor here, right?
Yeah, tell me.
So when we roll the money from one property to another, we go into a 1031, right? We buy another property. We continuously do this. Now, in the event that we pass away, the step up to our heirs is the step up where they inherited it, not from where we did the 1031 at, correct?
Yeah. So listen, the step up is, you're right. We're going to pass those properties on. The government's going to say that you bought the building for $1 million, but now it's worth $10 million. So we have to have a step up in basis because they always want to be in your pockets, right? And they always want to get as much money from you from all these different tax ways. So how do we prevent that, right? So, again, when you do the step up in basis, and a lot of people miss this, I think you can eliminate most of the taxes because we're going to apply that cost segregation to the step up in basis as well. So you tell me it's worth $5 million more. So what's the taxes on that? But we're going to find $5 million more in write-offs from applying the cost seg to the step up in basis. So that's one way we can, manage that step up in basis. Also, with gifting, right? We can gift up to a certain amount to our next generation without tax consequences. We can do charitable trust. We can do family trust. We can do limited trust. So again, more ways to maneuver through those taxes. And that's why we do what we do, right? And we write these books, right? To pass on that knowledge.
Yeah, well, that's what the wealthy have been doing for years. And now I love the fact that you're giving this advice to people that can't afford to have a family office, right? They can go out there, they can pick up your book, and they can understand all these strategies too, get their CPA to work alongside your firm, right? And get the benefits of everything that you're teaching along, bringing their CPA kind of along for the ride. Because let's face it, some CPAs don't even know about this stuff.
Yeah, I mean, most of our clients are CPA firms, right? So we're that engineering resource for them, that scientific resource for them. We do a lot of tax credits and tax incentive studies that they can't do in-house, right? So we've been that resource to the accounting community now for 25 years. And you're right, sometimes they don't know about it, and they don't know about all these benefits. And there's so many more benefits, tax benefits associated with investing in real estate, not just cost segregation, right? But the bottom line is, you got to be proactive, right? Because the accountants are learning new tax rules all the time. They're just finishing up 1015 tax returns. now they're faced with 60 days. How are they going to go out to all their clients now with 60 days left and do tax planning? It's impossible,
Exactly.
right? So you got to be proactive, right? You got to reach out to your accounting firm. You got to listen to podcasts. You got to read books, and you got to find ways to be more tax proactive.
So Julio, how did you get so smart? Where did you come from? How did you start? I know you weren't always in West Palm where you are now. You weren't always in the Washington circles, right? But how did you become America's tax reformer?
Well, I grew up in Miami, typical Latin family, 18 members in one house, so amazing, loving house, it was typical for our community. But, I was fortunate enough to, when I went to school, to have a mentor who allowed me to intern with him in accounting. And I just loved it. Who knew? I thought I was going to be a sports writer. I always liked sports. I was like, I want to write, I want to be a sports anchor. I want to be a sports writer. But, I fell in love with tax. And, but, for 20 years, I was working in tax, with the Fortune 500 companies. But really, the last 25 years, we started this company to be a resource to accounting firms and to their small business owners, entrepreneurs, so that we could have tax equality. Because without firms like us, there's no way accounting firms can bring this to their clients. And I just saw that inequality, and we wanted to, make sure that we fix that, right? Bring that closer together so that all people have unity in terms of using the tax code. It's so complicated. I get it, but so that's our little niche in the world.
It's also constantly changing, right? So it's not like something you can learn and then just go and do it. I mean, it's constantly changing.
We don't make it easy on accounting firms and individuals, because you're right, we're constantly changing. You wake up New Year's Day and now you have a new tax code, right? So the good thing about the big beautiful bill is a lot of things in there we made permanent. Now that's the first time we ever made anything in our tax code permanent. So bonus depreciation currently is permanent, right? This R&D tax credit, permanent. A lot of things we made permanent. So now I think accounting firms and their clients now can wake up in January and say, oh, okay, I got the same tax code. I don't have to think about what I'm going to do this year. We can tax plan all throughout the year and not be worrying about changes.
Onto a different side of things, right? The accounting space is not really what it used to be. People don't wake up and say, I want to be an accountant, I want to be a CPA anymore. It's kind of like a dying breed. A lot of CPA firms out there, they're having a tough time hiring talent, right? Retaining talent so they don't go into different sectors. Your firm actually alleviates that because it lets them introduce their clients where you guys do the heavy lifting on some of these products that they're not experts in. They're generalists, but they're not specialists, right? At the end of the day. With that being said, how do you see artificial intelligence making its way into the future of accounting?
Yeah, I mean, really, I think it's going to be a big solution for a lot of these accounting firms that can't retain or attract the talent. I think these younger generations don't want to work 100 hours during tax season twice a year. And who could blame them, right? I get it. That was a big struggle for me all those years. So I get it. I think AI can definitely help. And, that AI has to churn through, like I said, 2 million pages of tax code, all the case law, all the tax law. So it's going to take some time, because when I read AI and I use it and I test it on tax systems, it's always going back to 10 years, 3 years, 2 years ago, right? But the tax code changed so much. So it's not completely accurate. It's a good tool, but it'll get refined. There's no doubt that it's going to be introduced to a lot of the accounting firms. The biggest problem for the accounting firms is, how do they have time to, bring it in? And how do they have the resources, the cash to invest in that? I mean, that's the biggest thing, right? So, this is where you see private equity come into the accounting world and say, hey, we're going to, buy your company. We're going to buy a percentage. We're going to bring these tools to you to help you grow. And so we'll see how that evolves, but certainly it will be a big tool going forward.
Out of a lot of spaces, the accounting world is still a very fragmented industry. So there is
thousands of accounting firms, and like where you have the younger people that don't want to come in, we have the aging population of accounting firms and the owners and the partners that are like me plus 60 and like having to figure out, what do I do now? How do I transition? What do I do? I want to retire. So yeah, there's a big gap there.
I think tax planning, tax strategy, speaking with an accountant is super important right now when you have 10,000 businesses hitting the market every day from the baby boomer generation, right? They just want to sell their business. They're not really thinking about taxes. I mean, honestly, most business owners don't spend enough time thinking about taxes, in my opinion, because like Luigi said, Uncle Sam is more of a 33% partner in your business.
Yeah, when you sell your business, I see so many people that sell their business and they've worked their entire lives to blood, sweat, and tears to grow these companies. And then they sell the company, and now 50% is going back to the government,
Yeah,
federal, state, local. And it doesn't have to, right? Tax planning could eliminate a lot of these problems, but they're not getting that advice. They're not hearing about it from their accounting firms. They're not doing proactive work to think of ways to minimize that. So Uncle Sam is coming in, and when you're selling your company, more like a 50% owner, and taking all that benefit. So yeah, but there's a lot of ways to plan for that, but you have to be proactive and don't do it after the fact. I meet so many people that
that's the
sold
thing.
their business, have a big tax consequence, and now it's, a little bit late, right? They didn't do the plan.
Yeah, no, it's a shame because the average business owner, 80% of their net worth is tied up in their business. That's their biggest asset, right? So to have somebody come in and take 50% of that off the table could be detrimental to the person or their legacy and their family that they want to leave behind.
And it doesn't have to be that way, right? Just like you said to the audience, make sure that you're proactively working with your accounting firm and doing some tax planning. Be proactive in looking at ways to find resources that can help you and help your accountant with some of these, structures and knowledge to preserve a lot of that wealth.
Exactly. Julio, thank you so much for being here. We want to be respectful of your time. Can you tell everybody, well, we told them about the book and where they can get it, but how do they find ETS? How do they get in touch with you and your team to see if they even qualify for some of these strategies that we spoke about?
Yeah, no, I appreciate it very much. So we're at engineeredtaxservices.com. I'm on all social media at Tax Reform Expert. And, I put up daily tax tips and talk about tips on grants as well. So, anytime you're looking for some additional feedback, knowledge, to come visit our social media and websites.
Yeah, we're also going to be working with Julio and his firm. So if anybody has any questions, feel free to reach out to me and Luigi. You guys know how to get in touch with us. Outside of that, I have one question before I let you run. Not so much to do with tax, but more the state of New York and Florida. What is your prediction if the new mayor is elected in New York that they're expecting to win? What do you think the real estate prices in Florida? What do you think happens to them?
Yeah, I think they're going to shoot. I think they're going to shoot up, right? There's no doubt about it. We're already seeing mass exodus from New York down here to South Florida, and we're seeing the price escalations already. Now, what is Florida going to do to help with that? Right now, we are working with the governor to eliminate or minimize and bring down property taxes here in our state. We're also working with programs here at the state level to bring down the cost of insurance, because the insurance and the property taxes are going to go up, and as well as the prices of real estate. So we got to work on that as a state so that we do take advantage of those people that we want to have come into the state. So we are working at that at the state level. And I think we'll find some relief with the property taxes, the insurance costs, so that, and hopefully interest rates continue to come down a little bit so it's a little more feasible.
Well, if you guys have extra housing, we'll be more than happy to send you some extra communists down there.
Listen, I'm trying to get Luigi to move down here. So that was my sales pitch to him. He's still in New York.
Listen, I always tell Luigi, listen to this, like when I talk to people about tax planning, especially from New York, I say the best thing you can do is move from New York, right?
Yeah.
That would save a lot of taxes, right? But listen, we have offices in New York. We love the state, but when you have,
kills me is I love that adage: the good ones learn from their mistakes, the great ones learn from the mistakes of others. And what New York is doing is following the Connecticut plan that they failed 10, 15 years ago. They raised taxes. They made it very, very uncomfortable for businesses to thrive, and everyone left Connecticut. And New York is literally copying the playbook line by line.
Yeah. And New York and California, now they're trying to raise the taxes when you sell your home so that you don't sell your home, and also try to follow you for the next 10 years to wherever you move.
Yeah,
So
exit tax,
look,
right? Well, they want to exit
yeah,
tax if you're leaving, if your
yeah, they
business is
want the
leaving.
exit tax. They want you to this higher sales tax. So, you know, I just think that, it's just so difficult to be in these states with all the regulations and all the taxes, but maybe they'll eventually learn from all this.
Hopefully.
No, they will learn. It's a mindset. Julio, when you were in that home in South Florida with 18 family members, there was something inside you that made you thrive to better your lot in life. Right? You could have easily stayed there and said, "Hey, this is great. More for us to share." Right? Go on the
Yeah.
public dole, but you wanted better.
Yeah. And I had a good mom and good grandma that said I could do better and be better. So grateful to them for that support.
I love it. Julio, thank you so much. Everybody, that's a wrap. The Liquid Lunch Project. We'll catch you on the next episode.
Let's go!